Manish, welcome to our show.
Thanks for hosting me.
It's a pleasure, Manish. I know a hypothesis very dear to you is that disruptions create opportunity. Explain that to me.
Disruption creates opportunity, and one of the, as an observant, I looked at the rise of Airbnb.
The lodging company and private homes.
Exactly, which is a challenger to the hotel industry. And I've used
Disruptor.
Yes, and I've used Airbnb. And during my observation and while stay at Airbnb, I figured out that there is an opportunity to make money through the bed linen companies, because we can't own Airbnb directly.
It's not listed actually.
Yeah, that's right. And there was a bed linen industry in India which was growing up to a size, and you have got a few good market players in the bed linen industry, and that's how we played a bed linen industry in this.
How did the room nights go for Airbnb to give you that kind of confidence?
You would be surprised to know that from a 10 or 15 million odd room nights of exactly some 5 years back, they would be doing some close to 130 million room nights across the world. And what is very different about Airbnb versus the hotel industry is that you use printed bed sheets, not the institutional side of the bed sheets, and where India has got some kind of edge versus the others. And we invested in one company which was among the market leaders in the bed linen industry. And yeah.
So you actually, while staying at an Airbnb, thought this is the way to play it, and then you came back and did your research on this?
Yeah, exactly. So then after an observation, you need to go through and look at the competitive advantage of the industry and versus the market players and their strengths and weaknesses, and where there is a value for you as an investor, and then finally you figure out and you
Which year did you make that call?
It was in 2013.
And how is the bed linen industry panned out after that, in India or globally?
Yes, in India you have an advantage of cheap cotton, which is the sourcing advantage what India has, and today India has close to 47% market share in the US bed linen industry, and they've gained market share over a period of time, and so have the companies have become very valuable.
That's incredible, 47% market share, and it's a good second level thinking actually. Can't play Airbnb directly, let's play it indirectly through the linen market. In 2013, you had another hypothesis which you called Indian real estate the crumbling castles. How do you come across with that hypothesis?
I would say it was a bubble of magnitude which we have not seen over a period of time.
And this is just after 2008, the global real estate market crashed. Now you're saying in 2013, the Indian market was being pricked.
Yeah, but if you look at the data, the Indian market, the real estate market, the land prices or the housing prices would have at least quadrupled between 2008 to 2013, 14. And the way I reached to this hypothesis is my business takes me to a lot of small cities, and whenever I used to visit a small cities and I used to get an idea about the bubble in the housing prices or the land prices, it set me thinking that there's something wrong. And when I came back and disaggregate the whole chain, there were few key reasons why this whole bubble came to such a magnitude of disorder.
And they were?
And one was that there was a lax monetary policy by the government, by the RBI, not the government, the loose fiscal policy by the government, as well as a lax monetary policy by the government, which released a lot of liquidity in the system, and that created that liquidity
and it flew into real estate.
Exactly, in some order or a second. And second thing was also that in 2005 we allowed FDI in the real estate, and the FDI was supposed to create affordable housing, and rather than creating an affordable housing, it created inventory holding up and the rise in the price of the inventory, which created another set of problem for the real estate. And the third thing is that over a period of time, in that span of 2008 till 2012 or so, we had a negative real interest rate for the savers. So finally that inadvertently eludes you to get invested in the physical assets. Exactly, versus the financial assets.
How does a second level thinker like you come across with winning hypothesis from that hypothesis?
So when you go back on your drawing table and you see what all you could avoid, so one of the things was that you could avoid the direct real estate companies, and you would not take any exposure in the real estate companies where
Correct.
The underlying value of the business could diminish, or the derivatives of the real estate industry, which could be a very expensive high-end housing finance companies also, where there would be asset prices growth but not the volume growth,
and there be NPA problems.
Yes. And the second thing was also my hypothesis on the real estate gave me a good idea to not to look at investing in the banking sector. There is an exposure of the banking sectors in the real estate. They're close to 150 or 170, $80 billion out of the $900 billion book, which gave me set me thinking that apart from the mortgage business, also real estate has found its collateral in the banking sector. So there would be a problem in the banking sector because of this. So I avoided being invested in the banking sector.
Manish, you talked about real estate as a falling asset class, but you also like to catch falling knives. It's a very dangerous way to live in markets.
Rather, I would say when the knives have fallen, the dust has settled, and we have enough time to do the cherry picking of the businesses what you would like to invest in.
But how do you cherry pick, and is there a method to your madness of cherry picking?
There is a time value correction which a business or a stock price would undergo through.
Explain that to me in layman terms.
Oh yeah, sure. That would mean that the hypothesis is that people overpay for the growth. The market as an aggregate overpay for the growth. The market as an aggregate doesn't like to be invested in loss-making businesses. Market needs conformation. They needs conformity of the earnings. So when the businesses go through the cycle, there is enough time for you to do the business due diligence, run a screen, get those stocks in place, do the further business due diligences, segregate the companies what you like, and be invested in those companies.
So the first parameter of that is you check that market cap has not grown proportional to book value.
So we run various screens, and one of the screens would be where the market cap growth, the market business value growth is much lower than the book value growth. And you can use any time series based on your comfort, and finally you'll figure out something which will be a list which would be of some comfort to you, and then you could go further. This gives you a very good strength on margin of safety, so you have a very low downside when you do this kind of investing.
You also do a lot of scuttlebutt investing, in the sense you go visit AGMs, company conferences. How does that help you?
Getting to the annual general meetings of the companies, asking the right questions to the management, and in those 15, 20 minutes or 30 minutes you could get much more meatier information about those business strategies of the companies. Second thing is also,
there is actually a symmetry of information, so now you're loading it in your favor by going to those sources.
Exactly. So me and my team would do some 70 to 80 AGMs in a year across India.
It's a tough way to make a living.
Yeah, it's a tough way to make a living, but yeah, money making is not an easy, no one knows, but yeah. Yes.
But markets are made up of demand and supply curves, and the curve that you paid a lot of attention to, I know, is the supply side of the business, not necessarily the demand side of the business. Why do you do that?
Less attention was paid on the supply structures of the businesses, how the new entrants are coming into the...
Give me an example.
And I can tell you, we were lucky enough to make a few good investments based on this. 2012, we looked at the microfinance industry. After the knives have fallen, the dust has settled, and there was a
regulatory bloodbath going on.
Yes,
in Andhra Pradesh.
Exactly. From Andhra Pradesh, it went across the whole of India. And if you look at the industry structure at that point of time, out of 10 players, 70% would have been into the CDR. They were in CDR, and
only a few survived,
and very few of them survived. And during that survival phase, the industry shrunk. The demand shrunk and everything shrunk, and then no one would have looked at that industry where the demand is shrinking and you have some kind of regulatory structure overhangs.
But you have more market share now.
Exactly, for the winners. For the winners. And that's what the shareholders would love, to see a profitable business which would survive those downturns. We want a survivor.
Is the airline industry going through the same consolidation?
A part of it is yes, but I would have a different view. There is a consolidation which has happened, but there is also the ability to start a new business is a very small regulatory change. What you require is you can take a license and you can start, and if the industry becomes profitable, a lot more people with far better capital can come and be a part of the airlines industry. So I don't think so that that would merit in my scheme of things.
Warren Buffett has often spoken of billionaires who start an airline end up becoming millionaires, but actually, Southwest Airlines America has actually outperformed Berkshire Hathaway, but we'll leave that for another discussion, Manish. But which industry, according to you, is ripe for consolidation right now?
I can talk to you about about an industry where we have made an investment. Is the domestic branded fabric industry. Market is too obsessed with the ready-made garments. Market has overlooked the fabric industry, which is the tier 2, tier 3, tier 4.
And that's consolidated how?
This is consolidated. Maybe a decade back, there used to be close to 10 brands. You would list them 10 brands, and today exactly a decade of a long-term trend would give you an idea. In 2016, hardly 2 of them sits in a pole position.
You 2 or 3 of them. Predict them from the ones you know, Raymond and Siaram.
Exactly. Yes, I'm referring to them.
Correct.
And that pole position gives you a very good advantage. Whenever the industry revival happens, then you have an opportunity to gain the market share, to capture the pricing shares, and a host of things together.
Market share plus pricing. You have some pricing power inherent in 2 suppliers as opposed to 4 suppliers.
Yes.
Another hypothesis that we are very fond of is the dog that didn't bark from Sherlock Holmes. How is that helpful in investing?
A dog is supposed to bark.
Right.
And
it's unusual that they didn't bark,
yes,
so you
yes,
found
yes.
out the crime.
Yes, yes, yes. So I can give you an example. Just look at the banking sector. You need to be a bank which should have not grown somewhere in 2009, 10, 11 or so, and you are safe home today. So every bank was growing double digits, and every one fine day we would have a bank which is growing very significantly. Most of the whole industry was growing, and that was a time to be cautious.
And they all got marooned with the NPA problems.
Exactly.
Except the ones
you would land up. So you would land up if you would. I can give you another example. I've been on the buy side for some time, and in 2008, before the crash happened, you need to be a fund manager who was underperforming, because you need to sell your winners, protect your assets, be in underperforming stocks, and then just wait for that crisis to happen and to play it over. And that was a time maybe a lot of investors would have questioned you that you are not growing in the way that the assets are, or maybe the
industry or the markets
exactly,
are doing.
exactly. The returns are very different. Divergent answer is yes. That divergent need to be looked at very much more carefully, and that's where the proof of pudding lies.
Sherlock Holmes can teach us about equity investing. You know, there's another quote by Sherlock Holmes where he says to Watson,
yes,
you see but you don't observe. I'm happy to report for your investors that not only are you seeing, but you're also observing. Thank you so much for being part of our show.
Thanks a lot. Thanks for hosting us.
We'll see you next week on another episode of the Wizards of Dalal Street, a fresh breeze.